My name is Alexis Rogers, and I'm the Customer Relationship Lead here at RightCapital. And I want to welcome you to our RightTraining webinar today on a life insurance case study. And so today we're really going to be focusing on a major portion of financial planning, which is going to be looking at the life insurance tools and how we can adapt this to a case study. So today we are going to be walking through the two main tools that we have when it comes to life insurance protection needs conversations and how that can address two of the main questions when it comes to life insurance conversations. And more importantly as well, we're going to be covering how you can adapt each of those different calculations to the individual client. Because as we know, each client has their own unique needs that we're going to be addressing, especially when we're dealing with something that has so much of a weight when it comes to the financial well-being of a client. So we're going to be looking at all those different key aspects of the plan. And we're also going to be diving into just a couple of important key assumptions to note that can impact life insurance calculations and how you can just see what you maybe have for those assumptions and adjust them as needed. Now, towards the end of the session, we're also going to be diving into the different resources that you do have available to you when leveraging RightCapital. One of those resources being that during this webinar, if you have any questions, please feel free to use the Q&A section and type out your questions there. More than happy to answer any questions you guys might have. Now, switching gears into RightCapital. Today, we're going to be looking at the Sansa Stark family plan. And before we dive into some of the assumptions and a couple of the life insurance calculators, we're going to be first addressing who are we planning for. So we're going to be starting off under Profile Blueprint, because this is where we can see the nice kind of visual summary of the current plan for this family. And this is also where we can go ourselves to orient ourselves when it comes to who we're looking at today. So under Profile Blueprint, we can see this current net worth for the Stark family is currently $2.4 million, including their primary home and a couple of debts as well. They're also in their late 50s, early 60s, and they do have two children that they're concerned about making sure that, of course, will have a pretty nice inheritance when they do pass away, which is going to be one of the things, of course, that is going to be a main factor of today's conversation when we're looking at life insurance calculations and life insurance protection needs. Now, for their goals across their lifetime, they are planning on taking a family vacation this year and also next year as well. And then we also have them retiring at age 67, respectively. For current monthly living expenses, for post-retirement, we should say, they're looking at a $9,000 monthly living expense post-retirement. Now, if we go to income, savings, expenses, this is also where we can see the current income, the current savings and expenses for this family. Now, they do have some pretty decent income coming in, some pretty amazing saving habits, and also, of course, some pretty decent spending habits to note as well. Now, this is just what the current plan looks like for this family. Before we dive into some of the calculations when it comes to life insurance conversations, I want to first address the assumptions that can play a role when it comes to some of those conversations. So we're going to be navigating first under the gear icon setting section and under the other assumption section. Now, once again, gear icon settings, other assumptions. If we scroll to the very bottom here, under miscellaneous assumptions, this is where I can just see, and also just to show you guys what we're using here, the living expense reduction that will happen upon the passing of a client or co-client in this plan. And the reason why I want to address this is because I want to let you guys know I'm using 15%, for example, which is my global assumption. And this is going to have an impact because we're going to be looking at the idea of the client or co-client passing away next year in the life insurance tool. So this is going to be the expense reduction that will happen upon the passing of the client or co-client. This is a pretty important specification, especially when we're looking at that idea of life insurance or somebody passing away in the plan sooner than the client or co-client. Now, if needed, we do have the option from this drop down to toggle to customized assumptions. So especially if I know for this client that we're going to see more aggressive or less aggressive expense reduction upon the passing of the client or co-client, I can make that adjustment directly here as needed. Or in this case, we're comfortable using global assumptions, so we can keep that as is and hit save if needed. But just to note, that's what we're using here when it comes to the living expense reduction that will happen upon the passing of the client or co-client in the plan. And that's applicable for all aspects of the financial plan here, but it's especially going to be impactful when we're looking at one of the main tools in the system when it comes to life insurance conversations. Now, the main part of today's conversation is going to be found under our insurance tool. So if we navigate to the insurance tab, here we will be greeted with the life insurance analysis tool. Now, this is going to be answering the first question when it comes to life insurance needs. Now, what this particular tool is calculating is it's looking at what protection would be needed to guarantee that the surviving spouse has a positive ending portfolio value. What that's looking at is that question of what would we need in terms of protection in order to make sure that the surviving spouse is not completely decimated by all the goals and the expenses and everything that they're left behind with. And it's looking at the idea of the client or co-client passing away next year. With that being said, we can see here what the protection need is for client and co-client. And we're going to see a sub-tab dedicated to each client and co-client. That's going to be a unique calculation for each individual. But what's going to be really important here is really where we start to fine tune this calculation to this client, is that in the event, as we know, if somebody passes away, if the client or co-client passes away, a lot of their needs can shift. A lot of things can change. If we have somebody pass away in our livelihood, that we would need to reprioritize the goals, the expenses, a lot of that can definitely shift in those events. And that is when the action items comes into play, because this is where we would be going to specify some of those changes. Now, I already have a couple of things selected here for us to be able to make changes to them. But if we scroll further down into the action items and click on the edit button here, that's going to open up this drawer that allows for me to add or remove some of these action items. And what that just does is if I add some of these additional ones, it's just going to allow for us to start to make changes to those items. So for example, we have asset allocation selected, we have Social Security, the debt strategy, that's all going to be relevant. If we wanted to also maybe include the joint car, we can select that from this list. And maybe we're also going to include long-term care cost, just so that way we know what that's going to look like. We can hit save. And that's just going to bring those items to the action items here for us to be able to make changes to them. So some of the stuff that's going to be changing for this particular family that we've already started to adjust is the asset allocation. So it's going to be one of the first things I'm looking at here, because in the event where Sansa is, passes away next year, or her spouse passes away next year, the asset allocation is going to be shifting in that circumstance. So if we're trying to also incorporate that idea, we can change the asset allocation from here. In this case, we'll select conservative. Same thing for the Social Security strategy. So we have it indicated as part of the current strategy that they're filing at age 70, but maybe in this instance, if one spouse is left behind, they might be filing early. So if that's the case, we can make adjustments from here. So let's say that is going to be the case. We want to have some more income earlier on. We can change it from current strategy from this drop down, and we can indicate a different age or one of the main filing ages. Or I can select customized. And in this case, let's say it is going to be age 65, because that's just going to be relevant for Jamie. Same thing for Sansa. We can make that adjustment from here. And one thing to also note here is you're going to see a column dedicated to each event, because we're running unique calculations here or looks at that idea of Sansa passing away next year or Jamie passing away next year. So we're going to see a column dedicated to each calculation. So that's going to be what's used, all these parameters for that protection need calculation. Now, some other things that might shift as well is them retiring earlier, because in the event of them passing, they might need to retire earlier to start to take care of other things. It might change their needs. So we can start to build that into the calculation here. Some of the other things that might be impacted is maybe retirement monthly living expenses. As we saw, we do have the assumption that in the event that the client or co-client passes away, it gets reduced. But if we wanted to reduce it further, we can from here. Now, something else that probably would be adjusted in the event of the spouse passing away next year is that family trip. So if that's the case, we can zero out this event, or we can indicate that we want to keep that trip, whatever the case may be. But in this case, let's assume that we're going to be canceling that trip. Another thing that we also can look at from here, and that we have the option to adjust because I've added this, is a legacy goal. Now I'm going to walk through a little bit further what that means, but first I want to hit refresh. So that way we can just see, once we've started to make adjustments to those action items, we're going to see the protection need will reflect those changes, and that all we're adjusting down below is going to impact the protection need calculation. And the reason why this is important is because when we're looking at something like the legacy goal, what this is going to be doing, the legacy goal in general, this is taking that idea that we're going to have a devoted, guaranteed amount of money at the end of plan. So this is that idea of, in this case, let's say that the family wants to make sure that they have $500,000 of assets to leave behind towards their heirs. So if that's the case and we want to bake that into the calculation here, when it comes to the life insurance protection need, we can indicate the legacy goal to 500,000, scroll further down and hit refresh. So we can see how that's going to impact the protection need calculation here for additional reference. And one reason why that might be something that we might adapt to the life insurance analysis tool is because the tool itself is looking at that idea of how much protection would be needed to guarantee a positive ending portfolio value at the end of plan. So it just means $1 plus. So there's a positive ending portfolio value. If we're aiming at looking at that idea that we have $500,000, that's going to be passed on to the heirs because that's a need that this family has expressed to us, that's when we're going to incorporate the legacy goal. And that's when we'd use that particular goal to adapt the life insurance protection need as well. One thing to note, because I do see this as a question, under profile goals, this is where we'd go to add a legacy goal. So if I click to add goal, we'll see the option for legacy. In this case, I already have a goal entered, but I left it at 0. And that just means it's going to be available for us to propose changes to in some of the different proposals, including the life insurance needs calculation. So we can add that legacy goal under profile goals, add goal legacy. And once we go back to insurance, life insurance, we have the option to pull that into the action items for us to make a change to it. So in this case, we have had that discussion with this particular family, and a big concern for them is making sure that they have a good portion of assets tucked away for their kids. So in that case, we've baked in the legacy goal. A couple of those other things that we've also adjusted, and something that might also happen, it's not uncommon, is maybe we have to change jobs or careers if the spouse passes away. So if that's the case, we can also make adjustments to the salary. So maybe in this case, Sansa has to take a higher paying job, or maybe in this case, she has to take a lower paying job. So that way she has more time to spend with her kids or something along those lines. We can make those adjustments from here and hit refresh, and then see how it continues to start to impact some of the calculations up above. And another very popular strategy, and in this case, it's not going to be super impactful for them, but especially if we have a lot of debt in a client plan. And in this case, we had a couple debts that are existing. A very popular thing to pull in is the indication to pay off all debts immediately in the calculation, because it's not unusual for us to also say, in the event that the client or co-client passes away next year, we want to also consider the idea that we're not leaving behind all of the debts that they have to worry about. So we also want to bake into the calculation here the idea of paying off all those debts immediately. So we can select that from this dropdown. We also can pull in the debt proposal. So if we're using the debt management tool and we've curated a debt proposal from there, we wanted to pull that in here, we also have the option to do so. Whenever we make changes, as soon as we hit refresh, we will then see how it impacts the information up above. Now, diving into some of the summary visuals here, we can see from the protection need how much we would need for Sansa and Jamie as well. We would also see listed here any current insurance coverage as well, and also any proposed insurance. Now, the proposed insurance I want to note is going to be looking at in the action items, the ability for us to indicate proposed additional life insurance. So it's solely looking at the slider right here or the figure that we enter in this field. So right now I'm going to leave it at 0. And we will also be able to dive in the subtabs dedicated to Sansa and Jamie, or the client and co-client. And we can see here some additional insights. So we can see, what does the income look like if Sansa passed away next year? We can see how much we have in terms of income shortage. We can see where our income sources are coming from. We can also view the impact to invested assets if Sansa passes away next year as well. We can see when that dip happens or when we deplete those assets, at what age at least. Same thing for Jamie. We can see the similar information, the income sources, when we start to incur an income shortage and how much each year, and also the implications to invested assets if Jamie passes away next year as well. Now, the detail section will allow for us to see the cash flow level projections in the event of Sansa or Jamie passing away next year. So we can isolate the implications here for each client and co-client. So in this case, for example, we are starting to look at Sansa's event, and we can start with the cash flow summary. So in the event that she passes away next year, not going to be surprising, of course, the salary stops. So a lot of different implications will happen in the event of Sansa or the co-client passing away next year. So some things that will be stopping, of course, are goals, income that are tied to Sansa. So in this case, when she passes away, we will, of course, see the dip in when it comes to her salary. For some of the other income inflows under Social Security, we can also see here the Social Security calculation. So the system will automatically be calculating and considering all implications when it comes to Social Security or anything that they might be eligible for. That includes a survivor benefit if that's applicable, and the own retirement benefit calculation. We can see all that information from here. And we can also see any sort of other additional conversation pieces like that legacy goal at the end of life as well. And also the planned saving contributions. Of course, the saving contributions for Sansa stop when she passes away. So that does drop. We can see some of that additional information, the cash inflows and cash outflows on the year-by-year breakdown. Now from this dropdown, we can also view, and if we're familiar with the cash flows under retirement, the accounts information. So starting with ending account balance, we can see the year-by-year breakdown of the ending account balance. And we can click into each of these column headers to see the breakdown by ownership and how it's growing each year or any fluctuations. And we can also view any additions to accounts, required minimum distributions, withdrawals from accounts, and net cash flows. So especially if we're trying to isolate when we're starting to pull from assets to fund those negative net flows we were seeing, we can see some of that information from here. And we can also, of course, go back to ending account balance, see when we deplete those assets as well. Same thing for the co-client passing away next year. You can view that same information, both on ending account balance level, additions to accounts, RMDs, withdrawals from accounts, net cash flows, and cash flow level summary. So we can really start to isolate and view some of the additional insights found here. And this is just looking at one of the first conversation pieces when it comes to life insurance needs. This is looking at that idea of what do we need to guarantee surviving spouse is not completely decimated by what they're left behind with. The second question, and another tool that's often used when it comes to life insurance calculations, is actually going to be found under the 3 dots and under the calculator section. So under 3 dots calculator, this is where we can find the human life value calculator, which is often referred to as well as the income replacement calculator. So this is that secondary question that's typically reviewed when it comes to life insurance needs analysis. This is looking at that idea of replacing income. This is purely looking at 4 main pieces of information. And we're going to see a column dedicated to client and co-client in this instance. But the 4 pieces of information we're going to be looking at here are the annual income, the years to retirement, the discount rate, and tax rate as well. Now, I want to note here that the information we see when it comes to annual income and years to retirement, that is going to be fed over from what is entered under profile. But that does mean that we still have the flexibility here to adjust this information. So this is that kind of second question when it comes to life insurance conversations, which is how much do we need to guarantee the same lifestyle? You know, we want to still spend the same amount. We still want to have some of that additional information when it comes to that conversation. So we can also still make adjustments. Right now, $125,000 is Sansa's salary, $100,000 is Jamie's, but maybe in this conversation, we're looking to have additional income baked into this conversation. So maybe we want to have a little bit of a buffer here. So maybe we're increasing this slightly for client and co-client. We can make those adjustments. We also can adjust years to retirement. So if in this situation, we're trying to change the calculation, we can. In this case, we're going to leave it as is, but we're just going to hit refresh and see how it impacts the calculations up above. Now down below is going to be 2 other pieces of information that you can use to further enhance the conversation here. So that's the discount rate and tax rate. Now tax rate is going to be referring to the client's expected income tax bracket before retirement, of course. This is going to be one of the variables used to calculate this net income for each, client and co-client. Now, the discount rate is a different variable, of course. So this is going to be referring to the interest rate used when determining the present value of future income inflows. So right now it's set to 5%, but I could zero this out if I wanted to, and we'll see a higher figure up above. But in this case, we're trying to look at present value. So we're going to be using 5%, but maybe 25% is going to be a little ambitious. Maybe that's not their tax rate. We can make adjustments from here. Maybe we're looking at 23%, probably going to be pretty accurate for them. We can make those adjustments from here as well. Now, once we have fine-tuned the parameters down below, we will then see how it's going to impact the information for Sansa and Jamie, and we can use this information if we want to. In this case, it's very similar to the information we saw when we were looking under the insurance module. If I go back to the insurance module just for reference of the protection need we also saw there, that was also looking to very similar figures. So a little bit over 400,000 for Jamie, a little over 400,000 for Sansa. But based off of what we saw for the human life value calculator or the income replacement calculator there, for Sansa, if we're trying to maintain the same lifestyle in that event that she has higher income, we'd be looking at a higher policy. So that one was above 600,000. So just to know, we can use both that information for our reference, but those are the two main calculators we can use for that conversation. The next important step when it comes to us trying to implement or analyze an actual life insurance policy or trying to propose one is going to be when we target the retirement module. So in this case, we'd be going to the retirement module because we are looking at that idea. We do want to implement and show the impacts of having a life insurance policy. So we get a retirement analysis. This is going to be where we can have a different type of conversation. This is where we're going to see the first gauge of financial well-being. This is going to be looking at that probability of success. Just to take a step back, the probability of success is going to be looking at the Monte Carlo simulations, which are 1,000 trials of market volatility. And it's a percentage of those trials that make it to the end of plan without running out of money. So in this case, we have, of course, the current plan. We have a couple of different proposals we're also looking at already. We can see we have a 93% probability of success with our kind of current plan / proposed plan. But we also have started to carve out that idea of a life insurance policy. So if we scroll further down in the action items, I've already indicated one whole life insurance policy. And just to note here in the action items is where we go to indicate and curate our proposed plans. So anything that we add here or adjust here is only going to impact proposed plans. And once we add that item or make that adjustment and hit refresh, we will see how that's going to impact that probability of success and some of the other comparison visuals. Now, in this case, I've already proposed that Sansa takes out a whole life insurance policy. So I'm going to click on that policy, and we're going to see that this is something that I've indicated as a new action item here by the green dot. So clicking on Sansa's whole life insurance policy, we've indicated here, just to kind of touch base about what her policy looks like, her purchasing a policy, a whole life insurance policy next year. We've indicated that she's going to be the insured person or insured party here. The annual premium is going to be $8,500, and we're looking at a death benefit right now of $500,000. We have a little bit of growth that's going to be happening as well once we start to see some cash value. And another important designation here, as we've indicated, the death benefit is going to be face amount plus cash value. So this is just what Sansa's policy looks like. I am going to also be indicating and proposing a new policy for Jamie. So to do so, we're going to click on the edit button. To add a new item, we'd be clicking on the add new items button. And to propose an insurance policy purchase, we'd go to insurance and we'd indicate which type of insurance policy we're looking to pull in. In this case, we're also looking at another whole life insurance policy for Jamie. And the reason why we're proposing this policy purchase is because we want to see the impacts to their probability of success and to some of the other kind of proposed strategies we're looking at here. So in this case, I'm going to be titling us Jamie's life insurance just for my ease. And maybe if I have a different policy name, and especially if we're starting to leverage different proposals, it's pretty nice to have that titled. So that way we know when we're looking at the action items, which one we're referencing. In this case, we're going to be changing the owner, whether it's owned by client, co-client, jointly owned, or if we're actually looking at an ILIT, an irrevocable life insurance trust, we can indicate that from here. In this case, it's going to be owned by Jamie. Purchase year is going to be next year, so I'm going to change that figure. But we also can tie this to an age or life event. Now for insured, it's no longer going to be Sansa. We're looking at Jamie, but we also can model first to die policies, last to die, and also their children as well. In this case, Jamie is the one we're selecting. Beneficiary is going to be 100% in this case. We'd indicate that annual premium. When the premium is going to end, in this case, we're looking at a policy that will have the premiums end at 70. We're going to indicate that death benefit. In this case, we're looking at a smaller benefit for Jamie. For cash value, in this case, we're going to leave it at 0 because we're going to be starting to build that with this premium. So we're going to use simple growth here. We'd indicate the crediting rate that's going to be applicable for the cash value, the annual fee if that's applicable as well. In this case, it is. Further down is where we'd indicate if we have any sort of loan that we plan on taking out, or distribution, we should say. If that's the case, we can leave tax-free loan selected and indicate the parameters down below, meaning how much we're pulling, when we start to pull it, when it ends. We can also indicate a full surrender if that's applicable. In this case, we're going to select none. And then for death benefit option, we have the option of either face amount at $400,000 or face amount plus cash value, which is going to be the case for this policy. I'm going to hit save, and we're then going to see how that's going to impact the calculations up above when it comes to that probability of success. So you can see here, when it comes to the probability of success, we've increased it by 2%, which is still great. But now we also have some protections that we're considering here. Now we do have other key comparison visuals we can start to really understand the difference between these two plans with, such as the comparisons subtab. It is important to note when we're looking at the comparison subtab and savings and retirement details, that this is looking at a different type of calculation versus the probability of success. So comparisons is going to be pulling from the cash flow projections, and that's going to be a straight line projection, meaning that there's guaranteed returns. It's not factoring in volatility to the baseline, but we can, if we want to, implement different sequences of returns. In this case, though, we're going to keep baseline selected. So under comparisons, we can see here the difference of invested assets between the two plans, the difference of net worth, and the difference of taxes paid. Now, keeping in mind my only differences down below are the two insurance policies I indicated. So we can see here how much less we're paying in taxes, how much more we had in invested assets and net worth. And especially if we're looking at comparing policies here that have some sort of income stream that we'd be taking off of that, we do have under retirement details, of course, the income sources visual for post-retirement income. We can see here the income stability percentage, which is going to be looking at stable income products, such as Social Security, pension income, annuity income, and other income, which would capture the life insurance benefits. But if we go down from this drop down, we also have the option to compare income comparison. So especially if we're looking at a product like a life insurance product or an annuity product that's going to have guaranteed income streams, this is going to be one of those other beneficial figures here that show us the increase to stability income percentage. In this case, with the policies, 4% higher income stability, but especially if we have something that's going to be taking out maybe that income distribution over a couple of years, we can see that information from here as well. Now, just to note, if we go down to the action items and click into the insurance policy, because as you said, this is a question already, we do have the option to view the detailed schedule of this policy. So if I click on the view button, this is where I can see some of the key insights or kind of the illustration for this policy based off of the parameters I entered and the calculations that we have for this policy. So I can see here what the premiums are per year, the cash value, the net death benefit, which in this case, I indicated it's going to be face amount for death benefit plus cash value. But if we have a death benefit that's just going to be face amount, we wouldn't be seeing the cash value necessarily impacted there. And then we'd also see, if relevant, the loan income and loan balance, if that were relevant as well. And this is just going to be based off of the simple growth calculation, some of the parameters we entered in the whole life insurance policy. Now I'm going to be diving into Q&A because I see a couple of questions when it comes to modifying the illustration, which we can do.